Welcome to the latest edition of our virtual investor series. My name is Susanne Matern and I'm responsible for the European Structured Finance Analytical team. Today I'm joined by Markus Papenroth, head of our EMEA ABS team, and we are going to discuss the outlook for ABS and the impact of a cost of living crisis. So Markus, you have recently, I think in June, changed some of the asset performance outlooks for some of the subsectors to deteriorating while maintaining others on neutral. So what are the reasons for that?
So, as you said, we changed some of the asset assumption outlooks to deteriorating. I think the biggest risk at the moment might be complacency, actually. Just looking at the recent data, it all looks terrific. But we think the main impact on household finances will still to come. So we see inflation, we see good unemployment markets. So for us, the consequence is we focus on unsecured consumer credit. And we saw a deterioration, or we see a deterioration in the UK, we see it in Italy to some degree. At this point, we actually also think that Germany has some scope for negative surprises, more so, for example, than Spain, which is an interesting reversal than the last decade. And perhaps as a side note, we also changed the asset outlook for SME ABS to deteriorating, so not just consumer. Because we think that especially SMEs, with their inability to pass on input cost inflation, and perhaps also now getting under pressure on the revenue side, they're in a slightly worse position than they were before. And actually the German office looked in the German portfolio quite recently and analyzed that.
But to put it in context, and you mentioned it already, the labor markets are still very, very strong, very tight. In the UK, for example, we see, I think, record level of vacancies compared to unemployed numbers. So what's your take on that, and how does that impact, or how do we believe will it impact asset performance?
Yeah, sure. I mean, there's no doubt the strong labor markets help right now. So they help mainly on two fronts. They keep the negotiating power for nominal wages quite strong, so that helps to offset some of the real wage declines that we see. But they also, of course, help just generally keeping people in employment, which is obviously the main differentiator for unsecured consumer credit portfolios. But it's easy to forget perhaps that the average borrower, they might be just fine. Right? So we are not so worried about the average borrower. But if we look at the distribution behind it, so what costs are people usually most impacted by? The three main areas. And it's energy, it's food in the UK to some degree, and it's rent for some. And if you look at that distribution, as I mentioned, it's the low-income borrowers who have those items as their main cost factors. And these are cost factors that can't be delayed, they can't be substituted very easily. There was also recently a quite interesting study from the IMF who looked exactly into that kind of phenomenon. So how are people across the income and wealth distribution impacted by rising energy costs mainly? And yeah, they came to the same conclusion. It's the lower credit borrowers, the non-prime borrowers that we need to be concerned about. At the same time, of course, we also will recognize that those transactions with those borrowers had quite strongest structural features to them.
Oh, that's a good segue. I just wanted to clarify, because what we discussed so far related to asset performance, so the underlying assets in a transaction, but not to rating. So what are our rating outlooks, particularly for the more vulnerable asset performance subsectors?
No, exactly. No, it's a good point. So we need to be very clear. The deterioration that we highlighted to the market, that's really about the asset outlooks. And we shouldn't forget that most of the deals that we look at the moment, they've dealt with quite harsh assumptions for some time over the past 3 years through COVID. And even though we bring some of those assumptions actually down from that period, they're still allowing for a lot of deterioration in them. So it's really about the assets getting worse, but not the ratings. And as I mentioned, the structural enhancement certainly helps, and they are especially strong in these asset classes.
Maybe following up on the relative vulnerabilities, Does the market agree with our view? And maybe more interestingly, how do lenders actually react to it?
They are actually shared by investors as well. Some actually might be a bit more negative even than us. But it's unsurprisingly front and center of every discussion we have with originators and lenders. And all of them, almost all of them, certainly adjusted the cost of living expenses as part of their financial calculations. So in terms of accepting new borrowers, they actually act quite responsibly to that. The calculations, the increased calculations, the buffers, they are also playing part in granting credit limits, which is a bit more tempered these days than it was before. So new originations are relatively fine. The back book, of course, needs to be worked through. I mean, that's what's already in the portfolios. It needs responsible servicing now and remedial actions. There is one point we shouldn't forget: they are not in full crisis mode, right? And that's because they're not seeing the early warning indicators flashing red just yet. So it's obviously not enough to say there are no high arrears, so it's a bit backward looking. But also some of the early warning indicators that we look at, for example, in revolving credit portfolios, payment rates, or the distribution of transactors versus min payers, none of them really are showing or giving any cause for concern. So it's not surprising that, yes, everybody sort of increases their caution, but no one just throws in the towel just yet.
No, and that makes sense because we are starting from a very strong base, record low arrears levels, default levels. And as we discussed before, also the labor market is very strong at the moment. And there's another area that is a bright spot, if you will, that's the auto sector. Could you give us some comments on that?
Yeah, no, that is really, in some way, a joy to look at over the past few years, and still is. So it's not just because the benefit of owning a car is clearly showing through as a loan purpose and as a clear motivator for people to keep paying their loans. Plus, the unemployment is strong, so there's no pressure on the default side. But in some countries, of course, we are more exposed to auto prices. Not just through recoveries, which were very strong, but also through residual values. And the supply issues in the new car markets, which obviously are problematic from some perspective, but they clearly led to a very buoyant used car market and very high prices in the used car sector, which for the performance of ABS deals is great, right? So high recoveries. Sales at the point of handing back the car were very beneficial to the lender, actually very often at a profit. And in the UK, for example, in terms of voluntary terminations, it actually even allowed some of the lenders to offer voluntary terminations as some means of easing some payment pressures on the borrower and still achieve a profit selling the car. So that's actually quite beneficial, and we expect that to continue for at least the foreseeable future.
Oh, thanks. That makes a lot of sense. And I think coming back to the first question, this is also the reason why I think the auto subsectors are generally on neutral outlook, not on deteriorating. So thanks a lot for your insights. And thank you all for listening to us today. And if you have further questions, please visit us at fitchratings.com or send us an email to the address on the screen.